Okay, so last time we studied the operating cash flows, and we use our capital budgeting projects, right, to show how can we use the operating cash flow to do capital budgeting analysis. So all this work we have done is to be prepared, right, for our stock analysis. So why we study the financial statement analysis, right? We want to what? We want to evaluate, right, a company, right, to say this company is worth to do the investment or not, right? So today we will study the most important models, right, to evaluate a company called a free cash flow to the firm model and free cash flow to the equity model, right? And I think you already studied the discounted cash flow, right, in the principle of finance, right? We study how to use discounted cash flow to evaluate financial assets like the stock, right, bond, and the capital budgeting project, right? All this you can use discounted cash flow to do valuations, right? So to evaluate a company, right, especially for the fundamental analysis, right, the most important model and the most practical model for the public listed company is the free cash flow to the firm model and the free cash flow to equity model. So we will focus on these two models, right, to evaluate our company, right, in this semester. So let's take a review for the operating cash flow we studied in the last class. So let's do this question together. Right? So in these questions, we want to solve the operating cash flows. Right? Mont Blanc Lovers Livestock by Pennsylvania Incorporation, right? Project sales volumes for $1,650 for the second year, and the cost will normally run 60% of the sales, or about $990 in this case. The depreciation expense will be $100, right? And the tax rate is 35%. What is operating cash flow? To solve operating cash flow, there are different approach. For example, top-down approach, bottom-up approach, and also the tax shield approach. Right? In last class, when we use the capital budgeting projects, we choose our bottom-up approach. Right? So from our pro forma income statement, right, we start from a net income plus depreciation, right, is what? Operating cash flow, right? Operating cash flow also has a different name, right, called what? Cash flow from what? From operations, right? So next time if you see the CFO or OCF, they actually means the same thing, right? It means operating cash flow or cash flow from operations, right? Let's see how to solve this one, right? We say our sales for this company is 1650, right? And our cost are around 60% of the sales, right? So that's equal to the 990, right? That's the cost. And then we have the depreciation expense, right? It's $100, right? So depreciation is called what? Non-cash charge, right? Non-cash charge, right? Here's the depreciation, right? And so we have what? We have the EBIT, right? Operating profit, right? That's the sales minus cost minus what? Minus the net non-cash charge, right? That's the depreciation here, right? So our EBIT, right, is the 1650 minus 990 minus 100, right? Let's do a calculation, right? 1650 minus, right, 1090, right, equal to what? Equal to the $560, right? That's our EBIT, right? And for these companies, there's no interest expense, right? But we have what? We have the tax. Tax is 35%, right? So you will times 35% to solve the tax. EBIT minus the tax is our net income, right? Net income plus depreciation is operating cash flow. Well, let's see the calculations here. So first, we will solve EBIT equal to $560, right? Then we solve the tax based on the tax rate, 35%. We solve the tax will be $196. So our net income is the EBIT minus tax equal to $364, right? When you have the net income in your hand, you can plus the depreciation, right, to solve the operating cash flow, right? So we from the bottom line of the income statement, right, plus depreciation, we can get our operating cash flow. That's called a bottom-up method, right? Or you can use the top-down method, right? Use the sales minus the cost minus the tax. Be careful, operating cash flows, right? It's not including what? Not including the interest payment, right? Because interest payment is for the debt holder, right? For the firm, right? Should not take the interest expense out, right? It will be still belong to what? Belong to the debt holder, right? And also, right, for the depreciation, which is a non-cash charge, right? So it's also not included, right? So we also have the tax shield operating cash flow, right? So you can ignore these two calculations, right? The most important method, right, for these methods, we will use bottom-up method. So you need to adopt this method, right, to solve the operating cash flow, right, from the net income plus depreciation. So that's the questions, right, to review the operating cash flow, right? Let's also use another Excel sheet to review this calculation again. So you can see the input, right? Input including what? Including sales, right? And also including the sales price, right? So this is the sales quantities, right? And this is the sales price. The quantity times the price equal to what? Equal to the revenues, right? Revenue equal to the quantity times the price per unit, right? And the revenue minus the fixed cost minus total variable cost, right? Variable cost is based on what? Based on revenues, based on how many units you produced, right? That's 15% of what? Revenues, right? So revenue minus fixed cost minus variable cost, right? It will be what? It will be the gross profit, right? Gross profit minus depreciation, right? And minus the tax, and minus the other interest expense. For example, we have what? We have the net income, right? And net income plus depreciation is operating cash flow, right? So for these questions, we want to use the data, right, in a table, right, on Excel sheet to solve the operating cash flow for the years, right, 0 to 4, right? Time 0 is the year, right, for the initial investment, right? Time 1 to 4 is operating cash flow, right? And for the time 4, you can also get what? Salvage values, right? If you have the book value left for the initial investment, right? And also you can sell this fixed asset to the market, right? And you have the salvage value on the time 4, right? So it will be pay the tax, right? So salvage value should be also one cash flow on the time 4, right? Let's say the operation of this worksheet, right? It's also in your homework assignment, right? So please use the this lecture to fill the numbers in a homework assignment to solve this problem. And you can see here, What's the time zeros? Right? What's the time zeros cash flow? Time zeros cash flows, including the initial spendings on what? On the capitals, right? That's the original cost of what? The land, right? That's the initial cost. And also when you try to start your project, right? You have what? You have control of what? Working capital. That's a short-term expenditure on what? On the capitals, right? And also we have the what? We have the equipment cost, right? So all this will be the what? Will be the initial starting expenditures, right? So you can see here, right? Capital spending for the fixed asset plus the land cost plus the net working capital you control when you start this project, right? It's initial what? Investment, right? So you can adding these three numbers up, right? So these three numbers adding up will be what? $5,925,000, and that's your what? Initial cost. After you spending this money to start your project, right? With the sales, right, generate for the continued years, you can do what? You can do the pro forma income statement, right, for the coming years, right? For example, for the first year, your sales are given, right? Is the quantities you produced times what? Times the price, right? You can see the sale here, right, will be the 750 times what? Times the 3600, right? So you can see the calculations will be 750, right, times what? 3600. That's the revenue forward for the first year, right? Then we also have the calculations for the continued years, right? Use the sales in different year, right? Times the what? Times the price for this what? For this product, right? The price is 750, and so you use the quantities of the sales times the price per unit, right? You can got the sales for the different year, right? It's put on the revenue row, right? Then we have the what? Revenue must to minus what? Minus the cost. Cost including the two part. One is the fixed cost. It will be not change over the years. Whatever you producing more or less, right? This fixed cost will be still there, right? So you can say fixed cost will be always what? $415,000 for every year, right? Every year. Then for the variable cost, right, is increasing or reducing based on how many units you served, right? So our variable cost is based on what? Based on revenues, right? So the revenue times the 15% will be the variable cost, right? So you can see the variable cost row here, right? It comes from the 15%, right? Times what? Times the revenue, right? Times the revenue. So revenue times 15%, right, is the variable cost. So revenue minus fixed cost, right? Minus variable cost will be the gross profit, right? Gross profit minus depreciation, right, will be the EBIT, right? How about depreciation? Be careful. In these examples, it's not same as the example we show in the last class, right? Last class we have the straight line method for depreciation. That means every year we have the average depreciation are same for different years, right? But in this question, we have the MACRS, modified accelerated, right, depreciation method, right? So you can say you can got a 4 years percentage, right, for depreciation from the IRS, right? So you can got this percentage from IRS, right, for the different years depreciation, right? So our cost of the fixed asset, right, times what? Times the percentage for different years, right, will be the depreciation amount, right, you can get for this different row, right? For example, these numbers comes from our fixed asset cost, right? $3.5 million, right? Times by what? Times by the percentage of the depreciation on the what? On the first year, right? And for a second year, right, will be the fixed cost times what? Times the second year's percentage. Right? Third years will be the fixed cost times the third year's depreciation percentage. Right? Fourth year will be times the fourth year's percentage. Right? So you can get different depreciation on what? On different year based on this percentage given, right, from the IRS tables. Right? And you can see why we call this one as MACIs, because you can see we depreciate more at the beginning, right? Less depreciation in a later years, right? So that's why we call accelerated depreciation method, right? We depreciate more at the beginning, less, right, in the later years, right? So that's why we have the number reduced here, right? And then we have the revenue minus the cost minus depreciation equal to what? Equal to the EBIT, right? Operating profit, earnings before the interest and tax, right? And for these examples, there's no what? There's no interest expense, right? So we call this one also as what? Earnings before the tax, right? Because there's no interest payment. The tax rate is 38%, right? So your EBT times 38% will be the tax in different column here, right? EBT minus the tax equal to what? Net income, right? So net income is the EBT minus the tax, right? Minus the tax. Right? You can see our EBT, right, is given, and you use the 38%, right, to solve the tax amount, right? So gross profit minus tax equal to what? Equal to net income, right? And net income plus depreciation, right, equal to the operating cash flow, right? So our net income, right, this row plus what? Plus depreciation, right? You can solve what? Operating, cash flows, right? Operating cash flows. Right? So you get operating cash flows, right, in the different columns, right, for the what? For year 1, year 2, year 3, and year 4, right? All are solved, right, in this row. Then we need to add back, right, some cash flows on time 4. Time 4 is the end of this project, right? So you can release what? You can release the working capital. So you need to add in back working capital, right? And also you need to add in back what? The salvage value after tax, right? And also you need to add back what? Some capital spending you have remained, right? So what's the salvage value after tax, right? Will be the salvage value before the tax, right? Times what? 1 minus tax rate, right? 38%, right? So use the 350,000 times 0.62, we can got a salvage value after tax, right? You should write this number down, right, as the time force cash flows, right, for after tax, right, salvage value, right? You can see the number here comes from, right, right, and here, right, that's the price of the salvage value before the tax, right, minus what? Minus the tax, right? Tax is the salvage value, right, times the tax rate, 38%, right? And you can see our after tax salvage value is what? $217,000, but the number should be put here, right? And we also adding back what? Adding back the release of working capital, right? And also we have what? let me put these tables up, right? You still have the land value, right? Released from this project as what? 2.4 million, right? The land values you can choose at beginning is 2.3 million. After 4 years, right? The property, right? The land, the values what is going up, right? It's very possible, like in the real world, right? For example, if you look at the price of the Manhattan's apartment, right? Maybe 10 years ago, right? Compared with the price last year, right? The price are even higher, right? So the land price actually are higher after 4 years, right? So you also release the value of the land, right? After you finish this project. So here's the land values, right? You released, and this is the release of what? Working capital, right? And this one's the after tax salvage value of what? Fixed asset, right? Fixed asset, right? Fixed asset here is for what? For the purchase of what? Equipment, right? So you released this project, right? So you can get some salvage value of the fixed asset, can still sell to what? To the market, right? So you're adding all this cash flow to the time force operating cash flow. You got ending cash flows on time 4, right? On the ending value of the time 4 cash flows, right? Right? Okay. Now we can do the calculations, right? We can do the calculations. And then you have the cash flows, right? Availables in Word. Now you have the cash flows. You can do the calculations, right? By what? By adding these cash flows up, right? So let me first clear the contents first, right? And then we can erase the mark, right? Now let's do the calculations. Right? On time 0's cash flow, you can add in these 3 cash flows up. So let's add in the 3 numbers up. So that's the time 0's cash flows, right? That's the $592,500, right? Time 1's cash flows is equal to operating cash flows, right? Same for the second and third year, right? Time 4's cash flows, you need to adding all these numbers up, right? So including operating cash flows and also the other release of the land, working capitals, and salvage value, right, after tax. Right? So total will be 4124, right, 728. So that's the number here, right, you have. And based on these numbers, right, we can do the capital budgeting what analysis, right? And use our cost of the capital, right? Here's the required rate of return, 13%, right? So this is our what? Discount rate, right? So you can use this one to solve what? Solve the NPV, IRR, payback period, right? And profitability index, right, as a benchmark to accept or reject this project, right? So let's apply these calculations here, right? So most important one is what? Of course, it's NPV, right? So you can see here, right? NPV, then discount rate, right? You put, right? Then you choose the cash flow from 1 to 4 into a bracket, right? After you finish the NPV functions, plus initial outflows, right? You solve NPV, right? That's the 1,003,682.32 dollars. And also we can solve the IRR, right? And choose all the cash flows, right? Into the bracket, right? That's equal to what? 20%, right? And you can add in more decimals, right? If you want, that's 19.78%. And also we can solve the other, indicators, right? For example, payback period, right? Payback period. What's the payback period, right? You can add in the cash flows incrementally, right, to say on what year, right, on what year you can cover this initial cost, right, you add in the cash flow one by one, right, to the balance you left, right, to say on what year, right, this initial cost will be recovered. And you can see here, right, after 1 year, it will be still negative, right, still the balance, right, not covered yet, right, so we adding second year's cash flow, still negative, right, still in the bracket, right, adding one more, still negative, right, but number is much smaller, right, this number is even less than the fourth year's cash flow, so we take a proportion, right, this one over what, this one, we got a proportion, right, and then we change this one to the regular numbers, right, so that's 0.0697, right, this one should be what, should be positive, right, so that's the proportion of the fourth year you should take, right, to cover this cost, right? So our total payback period will be the 3 years already passed, right? Plus the proportion on the fourth year, right? So that's a 3.069744 years, right, for the payback period. And also you can solve what? Solve the other indicators, right? For example, discounted payback period, right? For discounted payback period, right? You need to transfer all the cash flows into what? Discounted cash flows, right? Use the original cash flow over discounting factor, right? How to solve the discounting factor is 1 plus discount rate raised to the time t, right? So you can choose the t in this row as the power of these exponential functions, right? To solve the discounting factor. So you can see our discounting factors are computed in this row. So use your original cash flow over discounting factors, right? You solve the discounted cash flow, and then you apply the same calculations by adding the cash flows, right, to the initial cost, right? One by one, right? To say on what year, right? You will cover all the what? All the cost, right? And you can see, right, how much you will left afterward after 3 years, right? And use that to divide by the 4 years, you got what? You got this proportion, right? So that's the discounted payback period, right? So for discounted payback period, you need to solve the discounted cash flow first. Then you will adding back cash flows, right, to the initial cost, right? To see on what year, right, the cost will be totally covered, right? Totally covered. Right, okay, so that's how to solve the, these indicators, right? Also, you can solve the PI index, right? Probability index, right? The PI index is equal to the total discounted inflows, right, over total discounted outflows, right? So that's equal to what? That's equal to the sum of what? Inflows, right? Inflows is this one, right? This is inflows divided by total sum of what? Outflows, right? And you can solve this ratio, right? That's equal to what? 1.17, and this is a ratio, it's a number, right? So you can based on these numbers to make a decision, right? You can say NPV, NPV is what? Positive, right? It's more than what? Even more than $1 million, right? So this project can generate a high value for the shareholders, right? And also IRR is more than the cost of what? Capital, right? And discounted payback period and the payback period is around 3, right? And our PR index is more than 1. So that means this project should be what? Should be accept, right? So that's how we use the pro forma income statement, right, to do the capital budgeting analysis. right? So for these questions, right, we just try to review our calculation of operating cash flow and also different depreciation method. Right? At the same time, we also study these functions, right, for the capital budgeting, indicators, right? So I hope this project, right, these examples, right, can give you some sense, right, to apply this knowledge we already studied. Okay, so that's for the Excel sheet. I also post on the homework, right? So please fill the numbers right into this sheet. Based on today's lecture videos, right, you can fill the numbers and finish these questions. Now let's go back to our PowerPoint. And you can see that's the operating cash flow we solved right in the examples and on the Excel sheet, right? So why we need to study operating cash flows? Because we need to use operating cash flow to do our, valuation for the companies, right? Our course called financial statement analysis. So our goals use the financial data in the financial statements, right, to do the, financial valuations, to do a recommendation of a company stock. So what's the important models, right, to do evaluations, right? We will prefer to use what? Free cash flow to the firm model, free cash flow to equity model. This is the most important model, right, in the financial statement, right, analysis, right, to do the company's valuation, right? You may wonder, right, you already studied the other models before, right? For example, right, in the principle of financial management class, right, we study what? We study the discounted cash flow models, right? And one of the models we studied for stock is what? Dividend growth model, right? Or you can call this one as a Gordon model, right? Because the Gordon is the economist, right? Designed this model, right? What is this dividend growth model, right? We use the D1 over R minus G equal to the P0, right? So we can use this model to evaluate, right, a company stock, right? However, this model is not perfect, right? This model can be only used for what? For a company, pay dividend. And also dividend is growing with constant rate, G, right? However, in a real market, right, not all the company pay dividend, right? And also not dividend always what? Growing, right? So this model actually is not popular, right, in a real valuation, right, for the companies, right? And also if the companies pay much dividend, it is not means the companies should be more valuable than the companies not pay dividend. Right? For example, the Google, right, and Amazon, right? They don't pay the dividends, but they are actually the better companies, more than the other companies paid much dividends, right? So we cannot use this model to pricing the stock, right, in the public market, right? So we will prefer to use the other models we will introduce right, in today's class. Okay, so the companies pay dividend does not mean it is a good company, right? The DGM models has so many limits, right? So we will not use this model in the real valuations, right? Especially for the Warren Buffett, right? If he do the valuations, right, use fundamental study, right? He not use dividend growth model, right? He will use what? He will use the free cash flow to the firm and free cash flow to equity model, right? This is the most important models, right, to evaluate a company, right? So before we study this model, right, let's take a review forward for the free cash flow, right? Free cash flow. So we just studied the operating cash flow, right? Operating cash flows is cash flow from what? From operations, right? Or operating cash flows, right? So you can say operating cash flow right? We already studied the calculations either bottom up or top down, right? But our operating cash flow also has what? Has some drawback, right? What's the drawback? You can see the operating cash flow, not including what? Not including the use of what? The use of long-term assets, or you can say long-lived assets, right? You can see when we solve the operating cash flow, we're adding depreciation back, right? So that means the depreciation actually is not considered, right, in the operating cash flows, right? So that's the problems, right? You know, for our companies, right, to run in the business, right, if they have a high proportion of assets is the long-term asset, they need to incur what? Depreciation, right? So our operating cash flows will be not good, right, enough, right, to study our what? Company's valuation. And also the cash flow, right, from operations not include what? Not include the cash flow outlays, right? For example, right, like what? Like the, you know, for example, you replace the old machine, right, with the what? With the new machine, right? Right, you need to what? Like we said, right, you need to, you know, you need to sell the old machine, right? And when you try to replace the new machine, right, you need to control what? You need to control the working capital and also start to use somewhat long-term assets, right? So all this is not included, right, in the operating cash flows, right? You can see when we do the capital budgeting analysis, right? Operating cash flows is from the 1 to 4, right? Only the time zeros, right, concern about what? Control of working capital and also spending of long-term capitals, right? It's not including what? In operating cash flows, right? After time 1, right? So that's why we don't use operating cash flow, right? Directly, right, to evaluate a company, right? We will prefer to use what? We will prefer to use the free cash flow, right? So what is free cash flow? So the free cash flow is the real cash flow, right? Company can use, right, after they already spending the money forward for the operating, right, expenditures. Right? So the free cash flow is equal to the cash flow from operations, right? Minus what? Minus the capital expenditure, right? So you can say if you have the long-term capital, right, you need to have the depreciation, right? And also for the short term, right, you need to consider about what? About working capital control and you know, long-term capitals, right? Spendings, right? So this will take out from the, you know, operating cash flows to solve what? Free cash flow, right? So let's say what's the model for the free cash flow to solve the company's values, right? So we always start from what? Free cash flow to the firm and first, right? For the free cash flow to the firm, right? It will from the top of the income statement. That's the cash revenue, right? So revenue must to what? Minus the operating expense, right? This expense is including what? Including the tax payment, but not including what? But not including the interest expense. Because for the firm, right? For the firm is the stakeholder forward for the debt and what? Equities, right? Debt we have the debt holder, right? For equity we have what? Shareholders. So when we liquid firm, right, we must pay the debt holder and the shareholders, right? Both are, you know, are the capital raiser, right, for the firm. So free cash flow to the firm must be not including what? Interest expense, because interest expense is also paid to what? Paid to the debt holder, right? That's the capital reserve for the firm. So this part should be not included, right? So the cash operating expense, right, should only including the tax, but not including what? Interest expense, right? So we should, minus the tax, but not minus what? Interest. Be careful, right? After you take the cash expense out, right, you're not finished yet, right, for the free cash flow to the firm, at least the free cash flow to the firm, right? Because when a company running their business, right, they must to spending the money for the operations, right? So they have the operation expense, right? So operation expense can be what? Can be short term and long term, right? One short term is what? Is the working capital investment. Working capital investment is the short term investment, right? And for long term investment, long term investment is what? Is the fixed capital investment, right? For fixed asset investment, right? So basically, our revenue minus cash operating expense, right? And also minus the working capital investment and the fixed capital investment, we have what? Free cash flow to the firm, right? So these cash flows are available to both shareholder and debt holders, right? That's the formula for the free cash flow to the firm, right? The most direct formula we can adopt, right, is from here, from this one. Right, that's very easy to understand, right? Because here is directly from our interpret of this process right here. So we have the EBIT minus the T, right? So that's this part, right? Revenue minus what? Tax, right? EBIT minus the tax, right? And we need to plus what? Non-cash what? Non-cash charge, right? So what is non-cash charge? Including what? Including the depreciation and amortization and all the other non-cash charge, right? Now we need to minus what? One is the short-term, right? Investment, that's working capital investment, and the long-term is what? Fixed capital investment, right? So that's our free cash flow to the firm, right? And then the other three equations you can actually derive, right, from this one, right, from this one. You can based on the EBIT formula, right, to derive the other what? Three formulas, right? For example, right, you know the EBIT times 1 minus T, right? Then plus interest, right, is what? Is the net income, right? And basically, right, you can derive this one, right, from what? From the EBIT times 1 minus T equal to what? Equal to the net income plus what? Plus the interest, right? We say we're not including what? Interest expense, right? So our net income from bottom up, right, should plus what? Plus interest, right? But interest is after tax, right? So you can say the interest here should times what? 1 minus T, right? And also in the future, studies, when we do the capital, when we do the valuation for a company, right? Our cost of the capital is our discount rate, right? Our discount rate is the cost of the capital, right? The cost of capital is what? Is the after tax cost, right? So that's why this part is also should be what? Consistent. That should be also what? After tax, right? Because our cost of capital is also concerned about what? Tax, especially that, right, will have the tax shield, right? So that's why we have the interest should times what? 1 minus T, right? Same for the other formulas, right? You can derive from this one, right? You can derive from this one, right? And you can see here, right? For a CFO, right? For a CFO, the cash flow from operations by equal to what? Net income plus what? Plus a non-cash charge, right? Minus what? Working capital, right? Investment, right? That's something we mentioned before, right? Our operating cash flows, right? Not concerned about what? About the non-cash charge and some long-lived assets, right? So we need to only, need to minus what? Minus the short-term, right? Working capital investment, right? So that's the CFO formula in the detail, right? So you can based on this one to derive this one, right? Same thing, you can derive this one, right, from this one, because the EBIT, right? Earnings before interest and tax, right? Plus the non-cash charge, right? That's the depreciation and amortizations, right? So you have the EBITDA, right? EBITDA times the 1 minus T, right? Plus what? NCC times the T, right? So this part is adding back, right? So you can say, you can basically derive the other three formulas, right, from this one, right? This one's directly from our interpretations, right, from this process, right? The other, just from operation of this one, you can get these other formulas, right? But for the, public firms, right, on the stock market, right, when we do the valuations, right, we will most likely to adopt this formula, right? This formula is the most important formula, right? It's NI, net income, plus the net, a net non-cash charge, right? Minus working capital investment, right? Plus interest times 1 minus T plus the fixed asset, right? Investment, right? Fixed capital investment, right? So this is the most important one. Why this one is most important? Because the net income is directly available to the income statements, right? And if the public firms, right, they must comply with SEC requirement, that means their net income from a statement of income, right, is very consistent, right, and also comply with the regulations, right. So the net income should be the direct source, right, to solve the what? Free cash flow, right. You can do the operations based on this one, right, to do the free cash flow to the firm. So this model, right, first, it is very good, right? It helps us to evaluate our what? To evaluate a firm, right? You can see our dividend growth model, DGM, can only evaluate what? Equities, right, or stocks, right? But our free cash flow models, first, you can evaluate a firm directly, right? So this one is much better, right? Then, based on your free cash flow to a firm, you can also continue to solve what? Free cash flow to what? To equities, right? So this part will be what? Evaluate and equities, right? Evaluate equities, right? So it will be similar to this one, right? But will be more what? More consistent, right? And also can be applied for the most companies, even they don't pay what? Pay dividend, right? So after you solve the free cash flow to a firm, right? These free cash flow to a firm are also forward for bondholders, right? It's not pure forward shareholders, right? So we must take the interest payment to the bondholder out, right? That remained will be the cash flow available to what? To the equities. But at the same time, right, when pay the equity holders, right? At the same time, you can what? You can raising the new equities, right? From what? From the equity holder or new borrowing from the bond holders, right? So here you can see here, right? You need to plus the interest payment to the bond. You should minus the interest payment to bond holder, and also minus the net borrowing to what? From the bond holders, right? Means you actually what? raise the more money from what? From the bondholders, right? When the bond are expired, right, you must pay what? Pay the principal. Right? You must pay the principals, right? So if you pay the principal, right, your free cash flows are reduced. But also you can what? You can issue more debt, right? So you can have what? More principal are borrowed, right, as what? As the new borrowings, right? So the change of these two will be a net borrowing from what? For bondholders, right? This is for the retail or expirations of the old or existing bond, right? This is the new raising of the debt, right? So the difference will be a net borrowing from the bondholders, right? So the free cash flow to the firm minus interest payment to the bondholder plus net borrowing from the bondholders, as we have what? The free cash flow to the equities, right? You can see here. The most important one is this one, right? So we use our free cash flow to the firm, right? We solved from the, these four calculations, right? Now we need to minus interest payment after tax, right, to a bondholder plus the net new borrowing, right? So we have what? Free cash flow to equities, right? And for these formulas, you can derive the other formulas, right, above, because you can replace our free cash flow to a firm, right? Use the four equations here, right? You replace this free cash flow to a firm, right? Using the formula above, right? And you can get the other four formulas, right, based on these four, right? So the last one will be a little bit different, right? Will be from the net income and also DR, right? Depreciation and the others, right? So we will not, use this one most likely, right? We will base on this one, right, and replace free cash flow to a firm, right, using the four formulas above, right? Okay, so let's see some examples for this part. So before we do the calculations, just a quick look at these formulas, right? So here we have the free cash flow equal to the cash flow from operations minus capital expenditure, right? So cash flow to the firm, right? Firm, including both equities and bondholders, right, are equal to what? Net income plus the net non-cash charge, NCC, right? Plus what? Plus the interest times 1 minus T, right? Minus working capital expense, right? And minus the fixed capital expense, right? That's the cash flow to a firm. So cash flow to the firm, right? The first part, right, for net income plus the non-cash charge minus working capital, right, is equal to the cash flow from operations, right? Then you can see cash flow from operations plus interest expense, right, minus fixed costs, fixed on capital expenditures, right, will be the free cash flow to a firm, right? Same thing. So you can tell, right, the capital expenditure for the firm, right, including what? Including the, the long-term fixed capital expenditures, right? But you need to add in what? You need to add in the interest expense what? Back, right? Because interest is belong to the bondholder. It's still, a part of the firm itself. Right? Should be not excluded. Right? Should be included, right? Then based on the free cash flow to a firm, we can solve the free cash flow to equities. So our free cash flow to a firm plus the net borrowing, right, then minus the interest for the bondholders, right, will be left will be what for the shareholder for equities, right? And you can see our free cash flow to equities eventually, right, if you replace this one by the formula above, right, we have the net income plus the non-cash charge plus the net borrowing, right, minus working capital minus the fixed capital expenditures, right, we have the free cash flow to equities, right? Let's see some questions to apply these formulas. So these questions to solve what? To solve the free cash flow to a firm. For the Quinton, right? Quinton is evaluating companies, right, based on these informations, right? So please help the Quinton to determine what is the free cash flow to the firm for this company, right, on this year. And you can see these companies generated net income $250, by interest expense $50, and depreciation 130, and also the other numbers, right? Let's say what's the free cash flow to the firm for this company. And I already highlight, right, non-cash charge, right, in the yellow colors, right? So what I highlight is for the non-cash charge, right? So our non-cash charge, including what? Including the depreciation, right, $130, right? And also including the restructuring non-cash charge, right, for $30. But we also have what? We also capitalized our intangible assets forward for $200, right? So on the product launch, right, we have the expense $240, but we capitalized this charge, right? It's $200, right? That's the something you capitalized. And so our non-cash charge will be what? 160 minus 200 equal to what? Equal to minus $40, right? Minus $40 million, right? $million, right? So our free cash flow to the firm equal to net income plus a non-cash charge, right? Something you already solved here, right? Then plus interest back, right? So we have the interest given in the last slide, right? Times 1 minus t. And after you finish this part, right, you solve what? Operating cash flows, right? Sorry. The net income, you plus the non-cash charge, right? Line what? Line minus the working capital, right? You have what? You have the operating what? Cash flows, right? So operating cash flows is what? Is the 250, right? Minus 40, right? Minus what? Minus 100, right? So that's the 250 minus 40 minus 100, right? 140 equal to 110, right? That's operating cash flow. How you know operating cash flows, right? Must what? Must to add what? You must to add in the interest expense, right? Because interest expense is belong to the bondholder. It will be still available to the firm, right? So we need to add in the interest times 1 minus t minus the spending for the long-term capitals, right? Expenditures, right? So we need to minus, right? 20, right? Minus 20, right? This I is interest, right? Interest is what? Interest from the last slide you can see here, right? Interest is the 50, right? 50 times 1 minus 30, right? 50 times 1 minus 30, right? So we have the operating cash flow, right? 110 plus the interest expense you're adding back, right? 50 times 0.7 is 35, right? Minus 20, right? So 110 plus 15 equal to $125 million, right? So that's our fixed cash flow to the firm, right? Calculations, right? You can directly apply our formulas, right? In these calculations, or you can use operating cash flow, right? Plus the, interest expense, right? That minus the long-term capital expenditures, right? That's also our free cash flow to a firm, right? Calculations. Also, sometimes, right? If you are not given, right, the detail for net income and the others, but you are directly given what? Cash flow from operations, right? Then our cash flow from operations should be what? Like we already specified in the last slide, right? Should be plus what? Plus the interest expense, right? Then minus long-term capital expenditures, right? That's the fixed capital expenditures, right? That's the 240, right? So we have the long-term capital expenditures, right? That's the fixed capital, right, expenditures. Right, so our cash flow from operations is 250 million, right, plus the interest expense, right, 50 times 1 minus t. T is the tax rate, 30%, right, and minus fixed capital expenditures, right, 240. So 250, right, plus 50 times 0.2, right, will be 10, right, and then minus 240, right, so will be 20, right. 250 interest expense 50 times 130, then minus interest expense 240. But let's say the calculation, do I make any mistake, right? 250, right? 50 times 0.2, right, will be 110, right? So 260, right? Minus 240, right? So should be what? Should be 10, right? Should be 10. Right, so here's a mistake, right? Right, I think here, right, in the previous notes, right, this part maybe solved in the wrong numbers, right? 50 times the 0.2, right? 100, so it will be the 10, right? 250 plus the 10, right, minus 240 will be what? 20, right? So the answer 260 will be 20, right? Will be 20, right? 20, right? Like we just solved here, right? So here should be the $20 million, right? Okay, so let's follow free cash flow to equity calculation, free cash flow to the firm calculations, right? Use the cash flow from operations, right? And after you solve the free cash flow to a firm, right? Right? You need to what? You need to minus the interest, right? Expense after tax, and also minus what? And also plus the net new borrowing, right? From the debt holders, right? Will be what? Will be the free cash flow, right? To what? To equity, right? So why we need to study these topics, right? For these two, because we can use these two calculate measurement, right? To continue to evaluate a company, right? Because what? Because our firm's value equal to what? Equal to the free cash flow to the firm divided by 1 plus what? 1 plus the cost of the capital, right? Right? From what? From the 1 to n, right? So basically, you take a discounted value of the free cash flow to the firm, right? Use our cost of capital as discounting rate, right? Then you adding all these terms up will be the value of the firm, right? Value of the firm minus the value of the debt will be the value of what? Equities, right? Value of equity divided by how many shares of the stock outstanding, right? You can solve the price of the share, right? And you can use that one with as a fair price of the stock, right? That's for the free cash flow to a firm, right? Same thing for the free cash flow to equity, right? Free cash flow to the equities, right? Will be used the cost of what? Equities, right? So will be the same PL model, right? As the cost of equity, right? Then use this one as discount rate, right? And you do the discounted values, right? For all the years, right? You solve the value of what? Equities, right? So you can say both way can help you to derive the value of the firm, and this is the value for the firm, right? Value of the firm, and this is the value forward for the equities, right? Value of equities. So please, take some notes for these two models. It is very, very important, right? We will apply this model, right, to evaluate our company, right? We have on the blackboard, right, to say what's the fair price of the company, right? What's the value of this company? I use these two models, right? Use these two models. So that's for today's class, right?